This is the Savvy Investor Podcast. What's happening, Savvy Investors? I'd like to welcome you to another episode of the Savvy Investor Podcast, where we discuss all things real estate investing, provide you with invaluable market insights and expert advice to help support you to live a savvy life. I'm your host, Mike Pawnee, founder of Savvy Investor and longtime Canadian real estate investor. Today's discussion is going to be a little bit sensitive, to be very honest with you. As of late, and I'm sure in our community they're well aware, private lending, especially using promissory notes, have been an extremely hot potato as of late. It's a delicate subject. And for those that aren't paying attention or not aware of this, the situation is that we're seeing a lot of companies and even individual investors become over leveraged. And in some cases, not getting the financing that they were hoping for when it comes to refinance to pay a lot of these investors back. In addition, we're also seeing some deals that are just piss poor management. Really just being very blunt about this, that individuals were just not being respectful for the capital that had been loaned to them for the particular projects. And honestly, this has been extremely devastating in our real estate investing community, where people have lost not just thousands, but in some cases, hundreds and hundreds of thousands of dollars. This is bad. It's been such a real bad discussion and some of the worst I have seen in 20 years of investing. And it is such an unfortunate situation. The sad truth and the sad reality is based on some of the things that I'm hearing and seeing. I'm privy to hear a lot of the information that tends to happen within the community. The worst is far from over. And for those that are feeling the impact right now, and this is impacting them and their finances, I am so sorry that this is happening to you. This should not be the case, which is why we are doing this particular podcast episode, because this is for you, for those that have been significantly impacted in this situation. And this is also for those that are considering private lending as a potential investment strategy as well. It's about being better investors. And I think everybody could have done a significantly better job by going through the process of due diligence, making sure that the projects were performing properly. In addition, for you your real estate experts, we need to be better. And so today's episode, we brought in the big guns. We did. And we brought in Graham Barr and Brandon Hans from Barr LLP. They're a legal firm, obviously, in Edmonton, but they service all of Western Canada, and they are mostly focused on real estate investing and also deal with promissory notes and private lending as well. And so we are going to go deep into this discussion because it's such an important one. And there's some key topics that we are going to be reviewing. And some of this is, for you money lenders that are in this situation. What if you're going through this situation right now, or your spider senses are tingling, that tingling feeling that something is wrong? What are some of the things you should be doing? And it's not about burying your head in the sand. This is the worst thing you could possibly do. We have to be active in this situation. Okay. So for a lot of us, we may already have private lends out there right now that seem to be going okay, but this is your time to double check and make sure. One of the other things we're talking about is contracts and understanding the agreements that we've signed, our real estate experts really providing the support as referenced in the agreements. And what about litigation? What if you are in a situation when the relationships don't go well and they start to sour? What are some of those key steps? In addition, what if you are in a project right now where the companies or individuals have declared bankruptcy or are now going through the process of a trustee to disperse whatever capital is still available? What are your next steps? In addition, for those individuals that are looking to invest in private lending as an investment strategy, what are some of the proper due diligence that should be done before you start to lend out your money? And most importantly, creative ways to get security to protect your capital. So again, guys, no promissory notes. You don't see the banks doing promissory notes. And honestly, why should you? It's not the way to do this. So this is what this episode is all about. As I mentioned at the beginning, this is a little bit sensitive. And this one was a little bit personal to me because I feel obliged to support our investing community because we have a platform to share. And we wanted to provide that support to help our community in any small way that we can. So we hope for those that are struggling right now, that are kind of in the thick of this, that some of the things that are shared within this episode is going to help provide you with some form of support, some guidance, to kind of help you kind of stick handle through the process that you're going through. But more importantly, as I said at the beginning, it's about making us better investors in totality. So before we begin with that episode, I'd like to highlight this episode's sponsor. Today's episode is brought to you by our savvy investor trusted partner, the Power Team. Do you have your sights on investing in real estate in Atlantic Canada? Look no further than the Power Team, led by founder and seasoned investor, Sean Power. Their team has extensive real estate investing experience and are some of the industry leaders helping countless of clients with both residential and commercial properties. They take a more integral approach with their clients by helping them identify risks and benefits of any property so you can make the most informed decisions about your investment. They're there to help you find the right property to ensure it fits your investment goals. I know this personally, as Sean Power from the Power Team are one of my team members for Atlantic Canada, and their service is second to none. If you would like to learn more or would like to connect with the Power Team, visit their website at powerteam.ca or visit the show notes with the link to their website. Welcome, everybody, to another episode of the Savvy Investor Podcast. And I am so fortunate to bring a couple of my team members from the Barr LLP team, Graham Barr and Brandon Hans from Barr LLP in beautiful. Is it beautiful in Edmonton these days? What's going on? There's no snow.
Oh, it's beautiful. It's beautiful today. Looking outside, the snow is gone. Green grass is coming. We're turning a corner.
I didn't think there was green grass in Alberta. Is there such thing as that?
About 3 weeks of the year.
Oh, okay. I was gonna say I didn't even think you guys actually own lawnmowers, to be honest with you. Just kidding. So for those that don't know, Brandon and Graham are part of the Savvy Investor Trusted Partner, and they are part of my Power Team. And I can't say enough good things about these wonderful gentlemen, which you guys are going to soon find out. These guys are just a wealth of knowledge, like especially in this environment that we're dealing with today. And for a lot of discussions we've had in the past, I was kind of thinking about this. We've talked a lot about corporate structure. We've talked about joint venture partnerships, but we're going to be talking about something a little bit different today. And it's a hot topic amongst our savvy investor community and our real estate investing community. And it's the topic called private lending. I'm not sure about you guys. Are you guys getting one or two calls about private lending these days? What's happening on your end?
Yeah, well, we represent a number of private brokerages. And so for the last 10, 15 years, we've been fielding a lot of these calls, but we're seeing a lot of these calls coming from people who are not going through traditional brokerages. And so it's certainly an expanding area. And it's getting a little bit more creative too.
Yeah.
And we're
So
seeing it.
Yeah, go ahead, Graham.
Oh, I was going to say, and we're seeing it on both sides. I mean, we do a lot of lender side work, and we certainly get a number of requests and or interest from prospective borrowers to find out how to do it. And we try to connect them with other team members of ours. But of course, it is just an ever expanding area right now. Interest rates going up, banks kind of tightening the purse strings. People are looking for creative ways to finance and or lifelines.
Yeah. And I think that's exactly what's happened is with the way interest rates have gone up. And I've seen a lot of this in the last probably couple of years. And it is really driven on interest rates. The banks maybe not financing to the levels that they want. Even financing changes, like with CMHC's policies changing where they need to hold the property for a couple of years. They're just like, wait a minute, that wasn't part of my initial plan. Now I'm kind of stuck here. I maybe need to extend on my private lend and I need to do some different things here as well. Secondly, we're seeing a lot of pain, specifically in Ontario, and when it comes to the private lending space, where guess what? The cycle has finally turned. It's gone a little backwards a little bit, and what they were hoping to kind of finance is no longer there. And then to add insult to injury, with these interest rate costs going up, it's creating significant impact. And some of these private lends were like, 12, 14, 16. I've seen as high as 18%. And it's painful. And so with that being said, we're seeing a little bit of insolvency. We're seeing a stoppage of people paying, borrowers paying some of their interest costs. And it's a really unfortunate situation. Are you guys hearing kind of some of the same things out there?
I will definitely collections are up.
Yeah.
We're seeing a lot more foreclosure enforcement. Graham doesn't really do that. It's kind of more my bag, but you certainly see a lot more demand letters going out, a lot more requests for extensions. And, usually that foreclosures are not that common, luckily, but when times get tough, they often skyrocket. So, it is something that we're seeing a rise on.
Mm-hmm. Yeah. And it comes to extensions. Is that a kind of a common thing that tends to happen, Brandon? Like I know for myself, when I've done some private lending, when I've actually been the borrower, I've had to extend 6 months, a year in some cases as well. More cases than not, it's not been a real big issue. They've understood it. But there was always a lot of questions about the deal in itself, and it was always secured against the deal. Is extensions kind of a normal protocol? Because I think for a lot of private lenders, especially for people doing this for the first time, and seeing a little of the turmoil that's going on, they're feeling a little bit nervous about an extension.
I would say they're probably not common. They're there, but you usually pay for it, right? So, if you want to stave off somebody taking a collections proceeding, saying like, listen, I want my money, it was supposed to be out today, and somebody says, I want another 6 months or a year, the lender may say, well, okay, fine, we'll do that, but the interest rate's going to stay and you're going to pay me a renewal fee equal to 5, 10, 15 points in the deal. And so a lot of the private loans we see, a lot of people struggle to take it out with new private loans to avoid that kind of double up fee. So, it is possible. It's happened. Sometimes it's a convenience factor, right? It takes you 6 months to 18 months to realize on a private loan, like if you ever had to sue somebody. And so, granting an extension in exchange for having kind of a waiver of some of the defense rights in a collections proceedings, that's often, we see that, so like we call that a forbearance agreement, right? Like we'll give you 6 more months to get this paid out. But if you don't do it in 6 months, we're just going to proceed right to the listing stage as opposed to starting a lawsuit, a statement of claim, and proceeding down the traditional enforcement tracks. So it's creative. Private lenders are a lot easier to negotiate with in that sense than big banks because, first of all, they're usually people as opposed to kind of faceless organizations. But it's expensive. It's very expensive.
Yeah. Now, for a lot of people that may be listening to this for the first time, and so, again, this is going to be recorded. It's going to be on a podcast. 6 months ago, 6 months from now, a year from now, some of this turmoil may eventually come to an end. But there's going to be a lot of new investors that are going to come out of the woodworks, and they see this as an investment opportunity. Is, hey, I can lend out my money, making probably a better return on my investment. And guess what? I don't have to deal with tenants. I don't have to deal with toilets. I don't have to deal with anything. And there's two kind of ways of doing this. One's more of a private lend against the asset in itself. And something that's become very, very popular in the last year and a half is promissory notes. And so maybe you guys can share a little bit about what they are, what are the differences and the pros and cons between them both.
Well, you hit the promissory note, Brandon. I'm going to hit the original security list. Oh, don't.
So a promissory note, I mean, for lack of a better phrase, a promissory note is a promise to pay. It's like an IOU. So if I borrowed money from Graham and Graham wanted a promissory note, all it says is I, Brandon Hans, have borrowed money from Graham and I will pay him back with this interest rate. If I don't pay him back, it's a breach of contract. And so my remedy is to sue him for breach of contract to get paid back. That's kind of rough and dirty estimation of what a promissory note is. Now it can be complicated. You can outline terms, you can outline events of default, timelines, you can outline additional security, which I would suggest anyone who gets a promissory note get additional security. But that's roughly what it is. It's the backstop of most commercial lending, is that there's usually a promissory note provided that kind of overarches the deal and additional securities added on top. And it's actually what most HELOCs are. So if you've ever gotten a HELOC, they're usually secured by a loan agreement or a promissory note, and the line of credit portion of the HELOC is that floating charge that additional security. So it's not uncommon. It's just how sophisticated you get and how much security you get in addition to that promissory note.
Which is exactly what we're going to lead into, which is to say that when we're speaking with first-time private lenders, that we outline specifically what types of security that there are available to secure against, and to have the conversations with the borrower prior to the signing of a commitment or a financing agreement or a promissory note, to have an idea or a picture of what the security is that there is available to secure against. So I think one of the issues that private lenders face is that they just lack the education in knowing what they can secure against. They look at it, a promissory note, and say, well, this is like a guarantee. You're like, well, no, a promissory note just outlines a debt, right? It's not more than the promise to pay, and it doesn't secure against anything specific. Like Brandon said, it can be a foundational document, but it's not the security itself. And part of the education that we try to provide is to say, well, no, you need to sit down with the borrower. You need to evaluate what it is that you intend to secure against. If it's a corporation, what assets does that corporation have? Are those real property? Are those tangible assets like trucks, other vehicles, other pieces of equipment? Is it, in the multifamily situation, all the fridges, stoves, and other kind of shelves that you can then charge against? You have to evaluate what that borrower has that's available for security. In addition to that, once you've outlined those things, then you need to speak to your lawyer. You need to speak to the person that is going to help you secure against those assets. And of course, the security that you can take are mortgages. You can take assignments of life insurance. You can take general security agreements. You can take specific security agreements. So one of the best things that we recommend is if you know somebody has a vehicle or pieces of equipment or farm equipment or other, you can get specific security agreement or specific security as against any serial numbered good. That, in fact, is much stronger than a general security agreement. So there's just an ever non-ending list of things that you can secure against, that if you speak to us, we're going to help outline what types of security are available that are far better than just an IOU.
Yeah,
And,
for sure. Go ahead,
and
Brandon.
a follow-up to that too is once you've outlined your list of security, one of the things a lawyer does is to make sure that nobody else has a claim against it. Right? It's all well and good to take a charge against the mortgage against the property or charge against a car, but if there's already somebody ahead of you who's a lender, and they have a debt outstanding that's worth more than what you're taking security in, how useful is that security, right? And so it's one of the things that even before you sign any commitments to lend, it's probably a good idea to talk to a lawyer just to say what are the terms of the loan. How much can be owing on the house that you're taking as a guarantee? Like that. Those are things that you have to structure properly at the outset, or else you get burned later on. Same thing with the borrower side, right? Like if somebody comes to you and says, I want a consent order or consent judgment before we sign anything, basically saying that if I ever miss a payment, they have a debt or a judgment against me, and I don't have the ability to defend that. Well, that's it's a common piece of security, but it's fairly strict. It's like a cudgel that can be beaten. You can use to beat you with, and you need to know what that means before you sign it, right? So, yeah.
So, Michael, you're chatting with us before, and I think I saw this a couple of weeks ago from Savvy Investor, which is what was happening in Ontario. There was a piece of property that had more debt levied against it than it could possibly have been worth.
Mm-hmm. Yeah, it's in Western Canada that situation that occurred, right? But yeah, so in this scenario, we had debt significantly higher than what the assets were worth, and I think there was two assets, and I don't know all the details behind this to be very, very clear, but this is part of the area of concern. I think that's an issue. That's a huge issue. Is like, how do you get to that state to begin with? And obviously, there's, I won't use the word. I'll let you guys use it, but it's a questionable. How about that? It's a questionable private lend. So anyway, that was the situation. So,
and I think that's another part of it too, which is like the due diligence factor and the education factor is massive. right? Like
Yeah.
if you were
Agreed.
provided the details of that property, and for the borrower, well, then not only can you do land title searches to see what kind of actual registrations there are against the property, but if you get the name of the borrower or the borrowers or the borrowing corporations, there's a number of searches that you can do as an individual, and certainly that Brandon and I can do as lawyers, and that would show some of the history, some of the security agreements in place, kind of give an idea to a potential lender what they're getting into with that specific borrower and that asset. And that due diligence, although not always perfect, is far better than I think the situations that you highlighted, that you could have a property that had much more depth than its value, because a search would have revealed same.
Yeah. I think the biggest thing that I'm finding here, guys, is the word trust. That's what it is they see people on social media, or they hear about it, and they've been in the business for a long time, and they just don't take the time to do due diligence. And first of all, like you said, Graham, is they've not been educated on this whatsoever. Like, they have no idea. They're just like, I know that Mike Pawnee guy. I see him on Savvy Investor. I trust him. I'm going to give him $500,000. That's not the right way to do it, to be very honest with you. And, I always use the term with a lot of my students is you should never trust anybody. First of all, it's trust, but verify everything that needs to be done. And I think part of the problem that I'm seeing is this whole promissory notes specifically is the big issue I tend to see. Is there's this IOU approach. People just don't really understand it, but they trust the person behind it. And so that's what they've done. And now it's all starting to kind of create a significant problem to begin with. So maybe to start this discussion, and so everybody understands it, is why do borrowers not want to secure against the asset that they're maybe using that capital for? What would be the main benefit and reasoning behind it versus doing a proper secured loan versus a promissory note? What's the benefit for the borrower, and why are they asking for that and willing to pay a higher interest rate for that too?
Oh, well, that's a loaded question. There's a lot there. I think before getting to it, you mentioned trust. When we approach a loan file, we approach it from the perspective of assume that everything the borrower has told you is not true, and assume that the worst possible outcome will happen. Yeah. So you lend the money, and then immediately afterwards they stop paying you. And so the question is, well, how can you recover on it? Now, to come back to the second half of the question, there are a multitude of reasons why somebody might go with private financing. There is kind of the traditional ones. They are self-employed, or they don't have a very good credit report, or they've gone through a bankruptcy, or they're going through a divorce, and they're subject to litigation. Right? These are things that a traditional Tier A or Tier B lender might say, yeah, sorry, come back, talk to us in 18 months. The next thing could be the security being offered might not be as pristine as a Tier A or Tier B lender may want. So it may be a derelict or rundown property. It may be something that's coming out of a health notice. If you had like an eviction order placed in the property, or it could be something else entirely that the person just doesn't have the cash flow to necessitate the loan from a traditional bank, but has other security, other assets that may come due. This is a case for a lot of farmers, in that they have unrealized assets that in 18 months they'll have, but they don't necessarily have now. So there's a number of reasons why you might not qualify for a loan. Why you might not want to offer security, that's another thing entirely. We see this with CMHC a lot. The COIs, or the certificates of insurance offered by CMHC, are fairly strict, and the organizational charts and the equity requirements are fairly strict. CMHC doesn't really care if you borrow the money, as long as it's not on title that you've borrowed the money.
Exactly.
And so a lot of times you see people saying, well, I'm going to buy this building. It's going to be CMHC. We're going to do a lift on it, and we're going to raise the rents, or maximize the rents at a later date. Well, doing that opens up the possibility of change of control and default under that loan if you have borrowed funds or liens on title or what have you. So that's just one example.
Yeah, I have a perfect one where we're doing a loan this week where the primary on title is a Tier A bank, but the secondary is private. And the CMHC refinance post renovation of this property will not allow that private to exist on title. And so the owner, the borrower, has sought financing by offering security on a number of other properties in return for the funds to clear off this second private loan. But all the equity in the entire project is kind of based in this building. CMHC won't entertain it while that's on there. They need to take it off, but the security is pretty skinny everywhere else. And our lender client has come to us and said, well, what do you think? And so we are working through a number of the security options about what they have available to them. But everybody clearly knows that post CMHC finance, they're going to get paid out if they get paid out. And so we start from the beginning and we just say, okay, well, what happens in the worst case scenario? Day one, there's no payment. The 95% CMHC loan comes through, but they don't send you the money. What happens? And so there are lots of reasons why you wouldn't offer the security over that primary asset, but doesn't really change the outcome for the lender.
Yeah, I agree. Yeah, I think that's the biggest thing that I see, and specifically the ones I tend to hear some of the most problematic are actually multifamily deals. To be very honest, it's like they exactly kind of think what both you guys are saying is they're trying to get the lift on the property, and that's actually kind of how they're paying it. So they may be going conventional financing to begin with, but then all of a sudden they're just like, okay, I got my conventional financing done, but guess what I'm missing is the renovation expense. So I'm going to do a private lend, charge 18%. I'm going to renovate the thing and then refinance it and then convert it over to a CMHC after the fact. Now, when it comes, you did reference CMHC doesn't like it. What about conventional banks for having a second security? Is that normal, or do they not like seeing this on title or against title at all?
Transparency, right? If you go into it and you go into an ask with a traditional lender about putting a second on, they will provide you a very clear answer, yes or no. There are lenders that do not mind second position with notice. There are others that absolutely clearly state in their original commitments, no secondary loans allowed without permission. Some none allowed at all. You go into it with transparency. Don't hope that you will put that registration on title and your first lender will not find out. If they do, boom, you're off into a default and possible foreclosure. So I mean, I come to it always from a position of always be transparent, always ask. Explain what you're after, explain why you're doing it, and you are much more likely to get a positive result than fingers crossed hoping that your lenders don't find out.
Yeah, I agree with that 100%, right? I think the more transparent you are, the less risk that you're going to be putting yourself and also your money partners in. And if that bank or that financial institution is not going to allow it, well, maybe it's just finding a different bank. That's it. And I think for us that are borrowers right now, that are real estate experts, it's not that there's private money that's not available. There still will always be private money, but the expectation of security and collateral is going to be a much more discussed policy that's going to be required. Everybody has to understand it. And for you money partners and lenders, I think it's just opening your eyes that, number one, you got to make sure you do your due diligence first and foremost, get yourself educated. And I think if there's any lesson to be learned is talk to the experts, like individuals like yourself, because I think the biggest thing you just stuck out to me is due diligence and understanding that it doesn't have to be the actual asset that it needs to be secured with. It could be other assets that could be that you could utilize to secure that promissory note as well. So maybe to talk to a brand new lender that is wanting to do a promissory note, but the borrower does not want to put it up on title for whatever reason, what are some of the common securities that they can take a look at, and how do they verify if that's real or not, and there's no liens or any of that stuff?
Well, that's again good question. It depends on what it is the lender likes. I've got lenders who, if they're lending on a commercial building or a multifamily building, but the person's got farmland somewhere, they don't care about anything else other than the farmland. And they will take the security over the farmland any day of the week. I've got other lenders who, they don't mind collecting or taking liens against cars. Some will say, I will only do it if I get a mortgage. And so it really depends on your risk tolerance as the lender, as to what it is you'd be looking for. And so the new lender comes in off the street and I want to lend them money. Okay, well, what's your expectation here? What's your risk tolerance? What do you feel comfortable with in terms of security? Like I've had somebody take security over a watering irrigation jack out of Saskatchewan. How do you resell that? I don't know. But the guy says, yeah, I can deal with that. So, it really depends on the person.
Yeah.
And there are some people, don't get me wrong, like you can take a promissory note that charges a property. It's not a mortgage, but it's still security against that property. There's some people who are comfortable with that too.
Mm-hmm.
If the LTV is quite low, you 10% LTV, and it's just a charge against the land, it's 6-month term, they'll be fine with it.
Yeah, as long as it's registerable, right? Like, so I mean that's the big thing. If we're talking no registration available on the specific asset that the loan is being used for, then you as that new lender have to be very careful and very knowledgeable. And as Brandon said, we have that conversation. What are your expectations? Because then they'll find out, well, what else is available? Well, there's personal guarantees, right? So though that borrower may not want to have a registration against title, their interest in that property or their interest in the corporation that may hold that property, they can pledge through a personal guarantee. If it's a corporate borrower, they can give a corporate guarantee over all of the other assets of that company. And of course, if you dig a little further, you find out what the person or company may have for other properties, farm, multifamily, investment, personal property, right? Your matrimonial home or, the house that you are currently living in. You can ask and as the potential lender, ask for security in those. There's nothing you cannot give security in. One of the ones that one of our lending groups loves taking as well is an assignment of life insurance. Right, so a lot of life insurance policies, whole life policies, have value. They have value if they were terminated, and so it could be 10,000, it could be 100,000, it could be $1 million that somebody has in their insurance policy. An assignment of insurance is a real popular one right now.
Good one. Never actually really thought about that, and that's a good way for having some security. So let me ask you a question. So if we go back to our junior private lender, person that's just getting started, if somebody's interested in getting started in this game, maybe you can highlight what would be some of the key steps they need to follow. Like technically they're the bank, they're making the rules. They should be kind of making the rules, to be very honest with you. What would be kind of the natural steps that they should do if they're looking at doing this for the first time?
Well, I would probably suggest going to a broker first, right? Like unless you know your borrower and you just want to you just want to start lending the money, approach a private broker and say, listen, I've got cash. I'm looking to lend in some deals. With the private brokerage that there's going to be some due diligence, some vetting, some processes that are in place. You don't have to do it all yourself. That would be my first step. If the lender knows the borrower and has already spoken with them about the terms of a deal, your next call would be to us, right? And we would kind of do an interrogation of the transaction, the proposed transaction. How much are you lending? What's the interest rate? What's the term? What's the security? What happens if there's a default? What happens if there's early payout? Are there balloon payments? These are the things that we would normally ask people. And I think before signing anything or agreeing to anything, you'd have that conversation first. Mm-hmm. After that's done, it can go a couple of different ways. Usually the lawyer will prepare the security paperwork and instruct borrower's counsel. And the reason we do that, and the reason we require a borrower to have counsel, is that lawyers can get certain undertakings and opinions about certain borrowers from borrowers' lawyers. Those are enforceable in their own right. So having two lawyers involved in the transaction runs up the cost a little bit is extremely useful for enforceability provisions down the road. And then basically once all the security paperwork is prepared and the lawyer is satisfied that the security that you're taking has been perfected. And when we say perfected, we just means that it's been finalized and is now enforceable. Then the funds are released and there's a paper trail where the funds go. Mm-hmm. So that can be a step-by-step guide, I suppose.
Yeah. Any additions, Graham?
No, I love the idea that if you're a junior lender and you do not know your borrower and you are just looking to get into the game, ask for referrals from people that you do trust who have been in the game longer than you about finding private lending brokerages, right? Okay. So I mean, whether you're dealing with like, I'm going to use some Alberta examples, but like DLC or other like mortgage architects, some of these large national kind of branded mortgage groups, they all either have private equity specialists or referrals to private lending specialists in their brokerage or other brokerages that are already doing the due diligence, vetting these potential borrowers and presenting these options, with risks associated to lenders. If you're not in the game yet or just learning about it, don't fall into the traps that a lot of obviously new lenders do, which is thinking that you understand the nature of the transaction, not having done it before. Go to people that know what they're doing. Ask a ton of questions, right? Like, you feel that you are satisfied or with either the nature of the deal or the information you're receiving, so that you're armed with all the information to make your own decisions.
I agree. Like, I think the biggest thing is experience really does help a lot, and talk to experienced people that have been doing this a long time. But I still don't think I think it's still worth everybody's, before you do private lending, I think it's important to really understand the deal to the best of your abilities. Like, and I joke around, but I don't. It's just like, I don't invest in crypto myself personally because I don't really understand it. And if I don't understand it, I'm just not going to do it. And so the question is, do you really understand what you're investing in? Get some clarity to this and have some clarity of the exit strategy that comes along with this. And secondly, get a second opinion. Ask, is this a viable deal or not? Because then that's going to help mitigate further risk. And then when you've got your professionals to help support you, then you're making sure that you're making the most informed decision to mitigate some of the risk. So, and I think part of it is, and correct me if I'm wrong, Brandon, when it comes to the legal costs, you highlighted some of the importance, highlighting that it's going to be costing a little bit more for private lending costs or legal fees. But I think those legal fees are to the borrower, if I'm correct, for both sides, if I'm correct. Is that right?
Usually.
Yeah.
So usually the legal fees for the lenders and borrower's lawyer comes out of the loan advance. It doesn't have to, right? Like that's something that your loan agreement would govern. I mean, if it's a sweet deal and you're getting 20% and you've got first position security on a bunch of assets, well, they may say you pay for your own lawyer. Okay, but the deal's got to be good enough for that. You don't see it very often, right?
Yeah.
The rule of thumb is borrower covers the cost. That being said, though, if the borrower is looking to get a certain amount of money and they're stuck with a $20,000 fees for their lawyer, the lender's lawyer, a brokerage fee, a finder's fee, they add up, right? And it kind of makes it a little bit more difficult to actually consummate the deal if the borrower is, saying this is going to be way too expensive. What's the point, right? So it's just a matter of finding the right fit, finding the right deal for the two sides.
Yeah, perfect. So as we've talked about kind of earlier on, we're hearing a lot of noise in this sector, in this private lending sector. And we're hearing some situations where people are stopping, or these borrowers are stopping to pay the interest payments. We're hearing some bankruptcies and I know we're probably talking two different discussions, but a lot of nerves. People are really nervous about what's going on, and they're getting these first inclinings of problems arising. And people are not wanting to extend. What's your recommendation if they're starting to see some things starting to not be as straightforward as they were expected to be, and specifically one, maybe communication not happening anymore. That's what I've been hearing. And secondly, all of a sudden interest payments have just stopped, but they may have communicated back to the lender saying, hey, we're just not making payments anymore. What, as a lender, what should I be doing right now? Because this is what we're hearing a lot, that people just don't know what the next steps are.
Graham?
Well, I don't want to just say jump to enforcement, because I'm always the problem solver first, which is to say keep the lines of communication open, right? Yeah. Have some frank discussions with your borrower about what hurdles they're facing, what are their pressures, what's preventing them from making that interest payment or principal and interest payment, and work out a solution. The knee-jerk reaction is say, well, I'm not willing to extend. Here's a deadline. You're overholding. You're done, right? Yeah, I'm going to put an enforcement date. May drive that person underground, or may force other decisions and force their hands. And so one of the things that I bring to my practice is always kind of okay, well, let's sit down and it's not necessarily mediation, but it's a conversation. Let's figure out what's preventing you from doing this. Now, granted, if you don't hear anything and it's just crickets from the other side, you're going to start dealing with somebody like Brandon, right? And so where they're going to outline the next steps of enforcement, right? And Brandon can run through kind of the laundry list of what that starts and finishes like. But one of the things that I say, just like from a landlord perspective, it's the same with like your tenant. What's preventing you from making this payment? What's going on? How can I help? Is it a matter of months? Is it that you're working on on a refinance that I'm not aware of? Do you just need time? What's happening? How can I help you? Those are also going to serve you well during communications with the courts. If you're going to court and saying, well, what steps did you take? Well, these are all my lines of communication. Here's what I tried: email, phone, right? Like offers, like how can we help you remedy this situation? Not just leaping into enforcement. That helps in the conversation with the courts. If you provided a number of these avenues and the borrower has not responded to those, then that's one thing. But I'll let Brandon hit off kind of here's what happens when or if communication ceases and you've got to start making decisions.
Yeah, so I think Graham's comment about line of communication is really important. I would probably stress every communication be in writing. Yeah. Because it's a lot easier to show a judge that you sent an email than explaining what happened in a phone call. So email communication is probably key. The way to enforce really is dictated by what security you have, right? If you have a general promissory note against somebody who is circling the drain, suing them may not be that useful, right? Because a promissory note just says I'll pay you, and if you game that out and you go get a judgment, and you statement of claim, go run through the process, they don't defend, you have a judgment against them. If they have no money, well, how do you collect? You can do searches and try to seize assets they may have, but to get to that stage, you've probably paid a lawyer anywhere between $2,500 to $10,000, and they've got no money, so it's a lost cost for you. Right. So a lot of times, unfortunately, we say to people, you might want to negotiate an extension in exchange for getting additional security, right? Something that you can enforce upon at a later date. By doing so, you kind of mitigate the risk that things can go sideways. Now, that being said, if the person who's borrowed the money from you is flush, or if you've got prime security, then your next steps would be having the lawyer get involved, send a demand letter. Basically, it's a formal demand to pay. If that demand letter is not responded to or the payment's not made, you'd start your debt action. Debt action is outlined by the court processes in each jurisdiction. They're all broadly the same, like BC, Alberta, Saskatchewan, Manitoba, Ontario, all have the same collection procedure. You start by a commencement document outlining the nature of the debt. It gives the opportunity for the defendant to the borrower to respond or file a defense, and then you go through kind of a discovery period that eventually leads to a trial. Now, that being said, most debt actions are not contested. There's really not a lot of facts that go into them that change. Fraud's the big one. If somebody's done a fraud, or if there's a dispute between partners on a project, there might be a defense. But for the most part, if failure to pay is pretty obvious. And so once you get your judgment, you go through the collections procedure. Again, will be different for different security. Like a mortgage is easier and different to enforce upon than a car or a boat, right? Both can
Yeah.
be valid security, but one is a lot simpler in process. One is a lot, I guess called the mortgage is more complicated. The boat, you just go and you send a bailiff to seize it. But yeah, it'll depend on each specific idea. Now, you also run into the issue of what happens if somebody goes insolvent when you're doing collections proceedings. Insolvency just means that you lack the funds to service your debts. It can translate into a bankruptcy. Bankruptcy is a process whereby the creditors of a bankrupt are kind of marshaled in order and paid out accordingly. And it kind of stops all collections actions against the bankrupt. That's why it's always a good idea to have security, because the secured creditors can continue against those items in spite of a bankruptcy, right? So, I think you would have to talk to a lawyer, because there's a lot of ins and outs that goes into collections that will change on file to file to file.
Yeah. And I think that's the thing is you guys see this stuff day in, day out for new lenders and people. This is a new world for them. They've never done this. For a lot of people, hey, I've been happy private lending. I'm getting 15%, every single quarter or whatever the number is. Everything's been honky dory. And then all of a sudden, what's going on? And they've been doing this strategy for a while. And this big hiccup is just such a big surprise. And now this is where they're feeling a little bit stuck. And, again, so like you were saying before, Brandon, some of these companies, we're seeing them going bankrupt, and there's questions all over social media. What's my next step? Should I talk to a lawyer? Should I talk to the trustee? I don't know what to do. And I think that's part of the discussion is I think you just got to reach out to the professionals first, get some of the right direction and let them answer, because you guys see this stuff kind of day in, day out, I would assume. Right. So,
yeah. And it's good to reach out to a lawyer who does this type of thing. Like, you probably don't want to talk to a family lawyer about collecting on a mortgage.
Yeah.
They're not going to know left from right in that file. So, talk to the right professionals as well. And arguably, like, if something goes sideways, the people who help you set up the deal, Graham and I are always going to say, talk to a lawyer when you do the loan. If the loan's going sideways, talk to your lawyers again. The same people. They're going to know what the deal is. They're going to know what the security is. And even if they can't help you, they're going to point you in the right direction, right? So you should lean on your professional network as best you can. That's what they're there for. You pay lawyers and accountants, and you pay them for the services and their expertise. So always rely on it.
Love that. Perfect. Good. We're coming to the top of the hour here, and I wanted to ask you guys one final question, which I have asked you guys before, and I will ask you again, but specifically in this situation and this topic, when it comes to private lending specifically, is just kind of final words of wisdom. People that are either getting in the space of private lending, or for those that are currently in the situation that they are in. Any advice, final words of wisdom, just to share with the community that may be dealing with one or the other situation?
Sure. I think I'm going to take that latter one, and we can talk to the former afterwards. But I'd say for those that are current private lenders, evaluate your security before you find out that your borrower is in trouble, or it's plastered all over social media that this group's teetering on the brink, and that's how you find out that one of your loans is in peril. Evaluate your current security. So reevaluate your loans, contact your lawyer, find out, just say, hey, I'm just looking for a sober second look. I've got this security on this loan, or I've got these pieces of security that I've been granted. I don't know if I have the backup documentation. I don't know if I've got copies of title that actually show that I'm registered. I don't know if the personal property registry in my area shows that the personal guarantee that I was handed is even registered. Can you just give it a look for me? I'd say that my words of wisdom are absolutely evaluate your current situation. If you're sitting on a promissory note and that's it, you want to potentially have that conversation with your borrower and your lawyer about, hey, I think we might need to take some additional steps just to give me more security, a better feeling in this, particularly when we start talking about renewal. And I don't think you're going to get a lot of surprised looks from your borrowers. So that would be my words of wisdom.
That is great advice. Brandon?
Words of wisdom with private lending. This is going to sound harsh, and I don't want it to sound harsh, but it will. Assume, if you're lending, that the borrower is lying to you all the time. Or ask your lawyer to take that lens when they're looking at things, because it's all, when everyone wants to lend money and wants to borrow it, everyone's happy. Everyone's moving in the same direction. They're getting something, the borrower's getting something that they want. Lender's usually getting a preferred rate of return. If the deal appears too good to be true, you have to assume that it's not, so that you can do your due diligence before you lend. Because it's a lot easier to just say, hey, we've done our due diligence. This looks shady, or it doesn't look like something I want to get involved in, before you lend the money. Because once the money is lent, it's gone, and it's all about recovering it, right? So, don't hesitate to ask for something. Don't hesitate to bring out the microscope and look under rocks and stuff, because that's where you're going to see kind of where the landmines are. And if you take that approach from the start, it makes it easier in the long run.
Man, just words of wisdom, obviously, guys. And, like I said, this is one of the reasons why we're bringing you guys on. Again, you're not only part of my team, but it just shows the experience and the knowledge. It's really unfortunate for everybody that's struggling right now. And trust me, my heart goes out to all of you guys. It really, really sucks. But I think the most important part is be a little bit proactive. Listen to some of the feedback that's coming back from both Brandon and Graham. And like I said, I don't think you want to sit on your hands, but you don't want to be overreacting either. But I think it's just, let's just get clear of this current situation that you're in, and then start to have some of the discussions probably sooner than later. Yeah. Gentlemen, thank you for doing this. Real quickly, if people wanted to learn more about both you two or Barr LLP, where should they be going?
Hit us up on the website first, www.barllp.com, barrllp.com. Both Brandon and I are under the lawyers listings or under the areas of law. I think that's the easiest one. Is just fire us an email. Mine's Graham at Barr LLP. Brandon's a B Hans at Barr LLP. Much more professional. Everybody in my world knows me as Graham. Everybody knows him as Mr. Hans. So
actually, I often get phone calls where people call me Hans. So
Brandon's the hammer. Right?
100%. Otherwise, I know Brandon's got a professional Instagram account, and I very much. It's so professional, and that we both do a lot of coaching and LinkedIn comments, and certainly, Michael, I've been chatting with you about the fact that when people are on Facebook and asking these questions and looking for comment, I'm doing my best to answer those. But anybody can tag me if they're looking for a response, and I'll do my best to try to respond on those as well.
Yep. Graham and Brandon have been both great. Both of them are part of our Savvy Investor Trusted Partner community as well. I can't say enough good things, and always appreciate your support in our community for sure. And for those that are wanting to reach out, that are listening to the recording or watching this through our YouTube channel, most of the information that you're looking for, if you want to connect with them or just learn more about Barr LLP, will be in the show notes below. So go ahead and check that out and give them a click. The one thing I really appreciate about these gentlemen is they're very, very open to talking and being open to share and ask, and help try to support our community. So, gentlemen, thank you guys for doing this. Looking forward to having you back on here in the very near future. But this was a hot topic right now. We want to make sure we jumped all over this one. So thanks again, gentlemen.
Thanks, Mike.
The views and advice expressed on this podcast episode are solely those of the individuals participating and do not necessarily reflect the opinions or beliefs of the podcast host, its producers, or affiliated parties. All content shared is for entertainment purposes only and should not be considered as professional, financial, legal, or investment advice. Listeners and viewers are strongly encouraged to conduct their own research and consult with qualified professionals such as financial advisors, lawyers, and accountants before making any financial decisions or investments based on the information provided in this podcast or any related content. The podcast host and producers disclaim any responsibility for any actions taken by listeners as a result of information presented in this episode. Viewer and listener discretion is advised.